I want to run you through the things I look for before picking an ETF as a certified financial planner. And as always, this is not financial advice. This is just what I look for when selecting an ETF. Everything I'm about to explain is on the product disclosure statements of the ETF and the fact sheet. So please read it before you invest. So the first thing you want to look at is the asset allocation. The asset allocation basically describes what you're investing in, which sector and which country. Looking at this will stop you overlapping and doubling up on your investments if you have similar ETFs with the same exposure. You could be buying a very similar ETF for no good reason, and then you're not as diversified as you think. You want to look at the investments you already own, and then look at the ETF's objectives and the asset allocation to check that you're not doubling up. Next thing you want to do is look at the expense ratio. You want to pay attention to this because this is the silent killer off your returns. What it is just a management fee that you pay to own that fund. And obviously, the higher the fee, the less returns you get to keep. So a low-cost ETF could range between 0.4%, which is 4 basis points if you want to get technical, to 50 basis points. In my opinion, anything above 80 basis points is expensive, and even if the fund has a bad year, you're still going to be paying those fees. So those fees can quietly come off your returns, and it can compound massively over time. The next thing I look for is the standard deviation. Now, this tells you how bumpy the ride is going to be, but let me explain what that number actually means. The standard deviation says it's 15%. That means that your returns can swing 15% higher or below the average. So an ETF tracking the world index, for example, the MSCI World Index Fund, which averages 10% annually, a standard deviation of, say, 15 means that in any single year, your actual return can swing between -5% or 25%, because that's 15% above and below the average. Obviously, the higher the standard deviation, it means it's going to be very volatile. By understanding the standard deviation, you know what you're in for. So it's going to help you avoid panic selling should it go down -5 or 10%. For example, if you take a thematic ETF, in technology or clean energy, emerging markets, a standard deviation for that would look like around 25% or beyond. So the same logic applies, but the swings are much harder. It's much more of a crazier roller coaster. The next thing I look for is funds under management, and that basically tells you the size of the fund. Now, the bigger the FUM, the more successful that ETF is. Basically, that number is just the pool of money that that manager has to invest with. And I generally don't invest in ETFs that are less than $100 million AUD. To me, that is a small fund, and there are some certain risks with that, as well as if you needed to get your money out quickly, it may not be as liquid as some of the bigger ETFs with a larger funds under management. Anything under 100 million, I won't take it seriously. The next thing you want to look for is the age of the fund. This is really important because you might end up buying a hyped up ETF that is absolutely brand new to the market and it has no data to show you its returns. Anything under 5 years, to me, is a risky fund to invest in, unless it has got a compelling objective. It will give you some past performance data, and even though that doesn't indicate how future performance will go, it will show you exactly how it behaved during different market cycles. And that brings us to past performance. We all know that it doesn't indicate what the future performance will be. It's not a guarantee that it's made 10% in the last 10 years on average that it will do the same. I like to look at it anyway because it just shows me how it behaved during different economic cycles. It's kind of like a personality test. If we take, for example, the COVID drop in 2020, as well as the interest rate hikes around the world in 2022, those were volatile times and basically everything got smashed. That would tell me how well that ETF performed and how it was able to bounce back from that. So if you're investing in an ETF that had a lot of exposure to hospitality and travel, it would have probably taken years for that ETF to bounce back. But those were just the economic times, so it just gives you context around how it behaves. Doesn't necessarily mean they were bad funds, but it does indicate how hard it swings in different economic environments. Meanwhile, diversified ETFs that are tracking, say, the MSCI World Index was down only 18%. That was still a bit painful, but not as bad as the tech ETFs that were down 50 to 70%. If you're still getting ready with me, the last thing you want to look at is the benchmark and the comparative performance. This basically tells you, is this fund doing its job compared to its benchmark? How closely does it actually track the index? This will basically show you if that fund is consistently lagging or not. So save this video for the next time you're considering buying an ETF. And if you want more investing content like this, that avoids the hype and you actually understand what you're about to buy, then follow along.